What part of these earnings momentum is actually factoring in better recovery, better vaccinations than we're actually getting?
So when we look at the earnings data, we've got to remember this is the fourth quarter. So this is effectively what was happening at the back end of last year. And that was really before the second or the latest phase of lockdowns in Europe was kicking in. So the data itself is somewhat backward looking, but nevertheless, we think it's pretty encouraging. You mentioned, your reporter mentioned just then that guidance looks good. So there seems to be a lack of sort of transmission, if you like, from some of the weaker economic data into corporate earnings, which is quite encouraging. And of course, we should remember that European companies are actually very global in their outlook. So, you know, the sort of the weakness we have in European economies, I think, is being largely offset by the strength we're seeing in the US and Asia.
Let's talk a little bit about Asia. A lot of European industrials are geared towards what is happening in China. We are starting to see maybe the economic impulse in China beginning to fade a little bit. Is that going to show up next quarter, do you think, in these European numbers?
Probably not, to be honest. But I do take your point. I think you have a peaking out of momentum in Asia and China. What I'm hoping as we go forward over the next quarter, we actually get an acceleration in momentum in Europe. So if you like, the baton is passing from the strong China-Asia driver over the last few months, moving forward into Europe. So there could be a case within a portfolio context to maybe shuffling some of your company exposure away from those most exposed to Asia and China, maybe putting a little bit more European exposure back into your portfolio, because as we get towards the second quarter, you know, obviously we're suffering at the moment from Europe's recovery being delayed by a quarter, but it probably means by the time we get to the second quarter, we're actually starting to accelerate as perhaps the US and other parts of the world are actually just beginning to sort of peak out in terms of losing a little bit of momentum.
Well, that's an interesting point. I wonder then sort of where and what kind of domestic equities make the most sense then to capture that perspective.
Well, I think it's banks. And again, you mentioned it in your last segment. But that's looking pretty encouraging for us. About 80% of European banks, we think, have beaten estimates this quarter. Our sector analysts here at Morgan Stanley are looking for 40% EPS growth for European banks over the course of 2021. So we've got strong growth over the next 4 quarters, and we're currently beating in this quarter. And actually, we're also getting some sort of guidance around dividends as much as these banks can say in terms of, obviously, the current restrictions. But the further we move through this year, those restrictions start to roll off. So when you look at the European equity market, there isn't an awful lot of large cap sort of domestic cyclical exposure. So I think by definition, you have to go to banks, and it actually fits with the thesis that we have that, you know, global bond yields will move higher. I think that can help the valuations of the banking sector, while the improving economic outlook actually also helps the earnings outlook too.